Hi guys, welcome in. I'm Alicia and I'll be your lecturer for today. So on the screen here you can see all of the free resources that ATAR Notes provides for you guys, and then as well as their other study resources that you can find at ATAR Notes Plus. So for today's lecture, just a little bit about me first. So I graduated year 12 in 2021 with an ATAR of 94.95, and right now I'm studying a double degree of IT and science at Monash. Today we'll be having two main content blocks with a short break in between, and then at the end, and then throughout the lecture we'll also be having a Q&A. So feel free to ask any questions that you have throughout the lecture. Feel free to ask them as they pop into your head, and then those will be answered for you immediately. Okay, so we'll get started with the content for today. So when it comes to how we should approach theory questions and how we should be writing our theory responses in our SACs and in our exam, there are three goals that we need to be hitting. So first of all, if the question is asking us to identify a specific term, so for example, if the question is asking how do we classify bank, cash at bank, how do we classify cash at bank? So what that question is asking you to identify is the term, so the classification. So in that case, it would be a current asset, right? So that would be the identify part of that question, but you can't get the full marks for that question just by identifying the term, so just by stating the classification. You also have to go further and define that term. So you've stated the term current asset, so you'll need to define that term. So write the full correct definition for that term in your response. And then thirdly, you also need to link it back to the specific scenario in the question. So a lot of the times with accounting questions, there'll be like a paragraph or a few sentences of background context, or just like an introduction to the question before they actually ask you what they want to be asking you. So for example, it'll tell you the name of the business, the owner, how the business, what methods the business uses, etc., etc. It might tell you the time period that you're reporting in, stuff like that. And that is what we call the context, or the background information on the question. So third mark, or what examiners are really looking for, is students who are able to link their responses, their theory answers, back to the context of the question. So for example, that might just be saying the specific amount that was that current asset. Even just that. Or when it comes to other theory questions, specifically, discuss or explain questions that are a little bit more complicated questions, that's where linking it back to the context of the question is really, really helpful, and it can get you those extra marks. So it'll take you from getting like a 4 out of 6 to a 6 out of 6. So, and that's what we want to be aiming for, right? We want to be aiming to get full marks. And then just in general, definitions are super, super important in accounting. Pretty much it's impossible to get full marks on pretty much any theory question if you don't know your definitions. And a lot of the easier theory questions that are just like, referring to one qualitative characteristic, you need to be able to know all the qualitative characteristics, and you need to know the definitions for all of the characteristics. And the same goes for the accounting assumptions and for the accounting elements. So assets, liabilities, and that current and non-current as well. the definition of owner's equity, the definition of revenues, the definition of expenses. So you need to know all of those definitions. So when we go back to the basics of accounting, the entire purpose of accounting, the whole reason that accounting exists is the role of the accountant is to provide financial information to the business owner, to whoever owns the business, so that the owner can make informed business decisions about their business. And in this course, so VCE Accounting Units 3 and 4, we primarily focus on smaller businesses. And so because we focus on small businesses, usually it's just one business owner. But there could also be accountants for big corporations where there are multiple owners, or you're also advising shareholders as well. But in the context of VCE accounting, we're only talking about small businesses, and we're also only talking about trading businesses. So we're not worrying about businesses that provide a service. For example, a massage place, right? Like the whole product being offered at a masseuse is the massages, which is a service. Instead of talking about those types of businesses in VCE Units 3 and 4 of accounting, we only talk about trading businesses. So that refers to businesses that purchase like some sort of physical product from a supplier, and then they will mark up the product. So basically they'll sell the products for a higher cost. So for example, if they purchase these shells from a supplier. So say if I'm the business owner and I purchase this shell from a supplier for $2, and then I'm going to sell this shell to my customers for $6. And that is so that I can make the profit. So that's what it means by a trading business. So basically it just means they purchase inventory or products from a supplier, they apply a markup or they increase the price, and then they sell it to their customers. And then you also need to know about the accounting process. So this just refers to the process involved, and the process that is required in order to get you to provide that financial information to the business owner. Because obviously you can't just take a brief look at a business and understand everything about the business and provide financial information and advice to the owner immediately. You need to go through a process. So that process is collecting source documents, recording those source documents, so recording the transactions, and then preparing financial reports. So that's your balance sheet, your income statement, your cash flow statement, and also budgeted reports. So budgeted balance sheet, budgeted cash flow statement, and budgeted income statement. Variance reports as well. There's a lot of reports. The point is preparing financial reports. And then once you have those reports, it's reading and analyzing those reports, and then based on the reports, providing financial advice and non-financial advice to the business owner. So that's your role as an accountant, is to basically look at the business, check their source documents, check their recording processes, prepare reports, and then provide advice. There are 4 accounting assumptions in VC accounting, and you need to be able to know the name and definition of all of the assumptions. So the first one is the accounting entity assumption. And that assumption basically just states that the business has to be kept separate from the owner and any other entities involved in the business. So for example, it needs to be separate from other shareholders, it needs to be separate from the owner's family as well. And this comes down to why we record drawings and contributions. So the whole purpose of recording drawings that the owner takes out from the business and contributions, so for example, cash contributions that the owner makes to the business. The whole reason why we record those transactions is because the owner and the business are two separate entities, and so we have to treat transactions between them as if it was a transaction with any other entity. Because some business owners think of, especially small business owners, because when you're a small business owner, you're really, really involved in your business. So a lot of small business owners sometimes think of their business as a part of themselves, which could be true, but financially they need to be treated as separate entities. The second assumption is the accrual basis assumption, which states that the business, so basically, there are three main components to the accrual basis assumption. So firstly, all revenues have to be recognized when they are earned. So that means that when the sale or whatever type of revenue it is, when it's earned, it needs to be recorded. And that's not necessarily when the cash for the revenue is received. Secondly, all expenses need to be recognized when they are incurred, which again might not necessarily be when the cash is paid, because obviously there's prepaid expenses and accrued expenses. And then thirdly, profit is calculated accurately as revenues earned less expenses incurred. So basically, that sounds like a lot, but basically all that is profit is the most accurate when it only includes revenues that have been earned. So this could be, this is only including revenues that have been earned, and it's not including revenues that have been paid but not earned, and it is including revenues that have been earned but not yet paid. So we're kind of ignoring the cash in the situation. So we're ignoring when the cash is received for the revenues. We're just thinking about when the revenue is earned. And the same thing with expenses. We're only including expenses that have been incurred. So we're not thinking about when the expense was paid, whether it was paid in advance or whether it has yet to be paid. We only include expenses that were incurred in the current reporting period. And basically the assumption is when we do that, so when we only include revenues earned and we only include expenses incurred, profit is most accurate. The going concern assumption states that when we prepare financial reports and information, we have to assume that the business is going to keep operating indefinitely. So basically, we can't prepare reports expecting the business to close down. Or say if the business owner tells you, like you're their accountant, and the business owner tells you, hey, we're closing down next year, so they want the report prepared a certain way, you can't do that. Even if we know that the business will close down, we have to assume that the business is never going to close down and it's going to keep operating forever, basically. The reporting period assumption states that reports should be prepared regularly for a particular period of time. And this could be every fortnight, every month, every quarter, so on. The minimum period that reports have to be prepared for is at least once a year because of tax requirements from the ATO. So at the very least, businesses have to prepare their accounting reports once every year because the ATO requires that of all businesses. But a lot of businesses will choose to prepare reports every quarter or every few months or every fortnight or every week or every month. And the reason why is because the reports end up being easier or more useful to the business that way. So, for example, if there's a problem in how the business is being run, if you're preparing reports every month, you're more likely to pick up on that problem and fix the problem quicker, as opposed to if you have to wait an entire year to get a report, then you're not going to know about that problem, especially if it's a small problem that's kind of flying under the radar. You as the business owner isn't going to know about that problem until the end of the year when the report is given to you. which is why a lot of businesses prefer to prepare reports in shorter reporting periods. And the reason why we have these reporting periods is to ensure comparability of reports, which basically just means that we need to be able to compare reports from different periods. So the whole reason why we're able to analyze reports and figure out what's going well with the business, what's not working with the business, is because we can compare those reports to previous reports from previous months, previous years of the business, comparing it to reports from other businesses, like similar businesses to ours. For example, if we're a clothing store, comparing our reports as a clothing business to other similar clothing businesses that also prepare reports, and then also comparing current reports to budgeted reports. So if I predicted a certain outcome for September, did the September reports meet those budgets, basically? And those are the 4 accounting assumptions. So moving on, there are 6 qualitative characteristics. And again, you do need to know the term and definition for all 6. And I cannot stress that enough. It's so important that you know the term and definition for all the assumptions, all the characteristics, all of the elements, and even all of the financial indicators and all of that. But those aren't as necessary. These assumptions, characteristics, and elements are super, super important, which is why I'm kind of going through them. Because in the SAC and in the exam, you'll have a question like referring to one qualitative characteristic, referring to one accounting assumption, or classify this. So it'll give you an example of a transaction and it'll tell you to classify it as whatever element it is. And in those theory questions, just stating the term and the definition is 2 marks already. So it's literally 3 marks. Just like memorizing the terms and memorizing the definitions is such an easy way to get marks, just by knowing the definitions and knowing the terms. And you also save a lot of time by having it memorized. You don't have to be in the exam like thinking about, oh, what was that characteristic, or what was that definition. So it's super, super important that you start from now memorizing these terms and definitions. Okay, but anyways, so the 6 qualitative characteristics. So the first one is relevance, which basically just means that we need to make sure that in our reports, we're including all information that's capable of influencing business decisions by the owner. So this might mean even not including some information. For example, like if it's not as relevant or it won't make a big difference to decision making, we might be excluding that. But it also might mean that we really need to be including certain information into our reports because it is relevant to decision making. The second characteristic is faithful representation, which basically just states that our financial reports must be complete, free from material error, and bias free. So complete, that just means nothing is missing. You know, as accountants, it's obvious that you can make a mistake. So you forgot to include a certain transaction or a certain title in the report. So making sure that there's nothing missing from the report. There's no errors, so you haven't accidentally written the wrong amount or added an extra 0 or didn't include an extra, like 1 0 less, spelling mistakes, anything like that. So no mistakes, no errors. And then the third one is free from bias. So a lot of the times the owner is very biased, the business owner. So they want their business to appear a certain way. That's a very, very common scenario that you'll be given with your theory question is the business owner wants the report to come out a certain way. For example, you know, they want their profit to be higher, or they want, I don't know, more assets in the balance sheet, because obviously with a higher profit and more assets, their business will look better. especially, for example, if the business is trying to get a loan, then the owner wants the business to appear in a better position because they'll be more likely to get that loan, or they'll be more likely to get a bigger loan. So that's just one example. But it's really, really important, even though the owner can sometimes be biased, that as an accountant, you stay objective and you kind of are able to ignore that bias, or like not let your own biases interfere. It's really important that you're just reporting the facts and the financial information completely objectively. And then, obviously, by doing this and by ensuring that your reports are complete, free from error, and bias free, this ensures that the reports are a faithful representation of the real world economic events. So basically, that just means it's more accurate. It's more accurate to the real life event that the report is representing. Comparability means that we need to be able to compare our reports. Verifiability means that if different people, objective parties, were to look at our financial reports, they should all be able to say that our report is faithfully represented. So if you prepare your report and then you show 5 random people the report, all 5 of those people will be able to agree that your report is complete, free from error, and bias free. And that's just basically, yeah. And another way to be able to do that is if we make sure that all our reports can be evidenced by source documents. So for example, if there's a particular amount, say if your balance sheet says cash at bank $5,000, if someone says, hey, where did you get the $5,000 from, you would be able to show the source documents and say, these are the source documents that I looked at, and show them how you got to that amount. And that's why source documents is really, really important to verifiability, because a big part of being able to double check and verify your reports is going back to the source documents. Timeliness means that we should prepare our reports in time to influence business decisions, so don't prepare them too late. So obviously, if we're reporting for February, we don't want the report to be ready in, I don't know, May, because by then February was a long time ago. We want to prepare it in time for the owner to make decisions. And then lastly, understandability states that our report should be easily comprehensible to the people that are using them. So we shouldn't include any complicated language, and we should try to use visual aids such as graphs or tables that can help to summarize information. And that's because you have to remember, even though the business owner will have some financial knowledge or a reasonable knowledge and understanding of how business works, they're still not an expert in accounting. So our accounting report shouldn't include any jargon or confusing language. And then again, you can use visual aids to help achieve understandability. So if you have a question that's like, why do we use graphs in our reports? The answer would just be understandability. Okay, we have our first quiz question. So the question is, explain how the use of source documents supports an accounting qualitative characteristic. And if you remember, I said the characteristic that relates to source documents is verifiability. So the reason why is because financial information should be able to be evidenced so that different users can reach the same conclusion that it's faithfully represented. And when we have source documents as direct evidence of our reports, it supports verifiability. And as you can see in this response, I've hit all 3. So I've stated the term, I've defined the term, and I've linked it back to the question. And actually, this was a bit of a trick question because faithful representation would have also been correct here. Either or would have been fine, but it would have just been a similar explanation. So there are questions like that where it could be either characteristic, but you just need to pick the one that makes the most sense to you. Okay, here's our second quiz question. When we classify the balance sheet, which qualitative characteristic is supported, and in this case it's understandability. And that might not have been obvious to you immediately, but the reason why is because when we talk about understandability, we want the reports to be presented clearly and concisely so that it's easily understandable to the people that are reading it. So by sorting out our balance sheet into these groups that make it easier to understand or comprehend, the people that are reading the report can easily identify which assets are current and non-current and which liabilities are current and non-current. And that, therefore, classification supports understandability of reports. Okay, here's the third question. So I kind of helped you with the first two, but for this one, I'll give you time to think about it on your own. So with reference to one accounting assumption, explain why sales is reported as revenue. I'll give you like 1 minute. Just think about it and kind of come up with your own answer, and then I'll go through it. And if you need to, you can go back to the assumptions because I know some of you might not have them all memorized just yet. Okay, so hopefully you all have something in mind. The answer is the accrual basis assumption, and this is because sales meets the criteria of being a revenue, and therefore it has to be reported as a revenue when it is earned, which will make sure that the business's profit is accurate for that period. And the criteria of a revenue just refers to the definition of a revenue. So we'll go through those definitions later, but it's an increase in assets that leads to an increase in owner's equity. Okay, so now we'll go through the accounting elements. There are 5 accounting elements, and it's really, really important that you know all of them and their definitions. The first element is an asset. It's a present economic resource controlled by a business as a result of past events that will provide future economic benefits to the business. So for example, if you're talking about cash at bank, it's a present economic resource controlled by the business as a result of past events. So for example, taking out a loan would be a past event that would lead to the business having cash. And it provides future economic benefits because obviously in the future the business can spend that cash to purchase assets, other assets, or pay off liabilities, for example, which will benefit the business in the future. And then obviously we have current assets and non-current assets. So the only difference is the exact same definition, but with current assets, those economic benefits will be provided within the next 12 months after the reporting period. And with a non-current asset, the economic benefits won't be within the next 12 months, and instead the asset is not held for the purpose of resale, and it will provide benefits for many years, or it will provide benefits for a period greater than just 1 year. The second element is a liability, which is a present obligation of the business as a result of past events. For example, a loan is an obligation of the business. So when a business has a loan, they're obliged to pay off that loan. So that's the obligation as a result of past events. So the past event in this case is the business taking out a loan. And it can be current, which means that when a liability is current, it just means that you can reasonably expect the liability to be settled within the next 12 months after the reporting period. Whereas with non-current liability, it's not required to be settled within the next 12 months after the reporting period. So for example, if you have a 3-year loan, obviously part of that 3-year loan will not be required to be settled within the next 12 months after the reporting period. But say that the business has a really, really successful period or a successful 3 months, and they have a bunch of extra cash lying around, and so they decide to pay off the loan early. Obviously, in that case, even though part of that loan was a non-current liability, they ended up paying the entire loan within 12 months. But that is an exception. So we basically say, can you expect this to be settled within 12 months, or is it not required to be settled within the next 12 months? The third element is owner's equity, which is basically it's whatever is left in the business out of our assets after we subtract liabilities. Because obviously the accounting equation is assets equals liabilities plus owner's equity. So whatever is left over in assets after liabilities have been deducted is the residual, which is the owner's equity. So basically, this is kind of a visual for you guys. So the business has a certain amount of assets, and then out of those assets, we subtract liabilities, and then whatever is left out of the assets goes to the owner. It's owed to the owner, so it's owner's equity. So, as I was saying, the accounting equation is assets equals owner's equity plus liabilities, but if we were to rearrange that formula to be able to find owner's equity, it would be assets minus liabilities. So you can rearrange the accounting equation. The fourth element is revenue. So a revenue is either an increase in assets or a decrease in liabilities that results in an increase in owner's equity, not including a capital contribution. So first of all, a revenue cannot be an increase in assets and a decrease in liability. It'll either only be an increase in assets or it will be a decrease in liability. It can't be both. So when you're, for example, if someone asks or a question asks, why is sales a revenue? You would have to say the definition, but you would say it's an increase in assets. You would not say sales is a decrease in liability, because a sale isn't a decrease in liability. So you have to be careful when you use this definition because it needs to apply to the specific revenue that you're talking about. And then the second interesting thing with this definition is it specifically states not including a capital contribution. So if you get a question that says, why is capital contribution not included as a revenue? You would just say it's explicitly stated in the definition of a revenue that capital contribution doesn't count. That's the only explanation you need to know, because it's stated outright in the definition of a revenue. And then we have an expense, which is kind of the almost sort of the opposite of a revenue. It's an increase in liabilities or a decrease in assets that results in a decrease in owner's equity, not including drawings. So once again, like a revenue, it'll either be an increase in liabilities or it'll be a decrease in assets. It can't be both. So for example, rent would be a decrease in assets because we're using our cash to pay rent. So we're decreasing cash. It won't be an increase in liabilities, and it can't be both. And then again, it's not including drawings. So if you get a question that says, why is drawings not included as an expense? You would say, because it's specifically excluded in the definition. Okay, so here's another quiz question. So the business borrows $20,000 as a 5-year loan. For each of the 5 years of the loan, the business will pay $4,000 to the bank until it's repaid. How would this loan be classified, and which accounting element would the loan be? So that's what classified means. It's just you need to classify what accounting element it is. So you need to say the element, the definition, and link it back to the question. So I'll give you 2 minutes to have a go. Try to, if you have paper, write your answer down, or even if you don't have paper, just think of your answer in your head and have it ready, and then I'll go through it. Okay, so I'll go through the answer now. So the element is a liability, and actually it's both a current and a non-current liability. So hopefully you caught on to that. So part of the loan, $4,000 worth, is a current liability because it will be paid off within the next 12 months. So within the next 12 months, within the next year, they need to pay at least $4,000 worth of the loan, because it's $4,000 per year. And then the remaining $16,000 of the loan is a non-current liability because it will take longer than 12 months for the business to pay it off, and it's not required that they pay it in only 12 months. And you can see in the explanation that both of the terms have been stated and defined. So current liability was stated, current liability was defined, non-current liability was stated, non-current liability was defined. And you'll also note that specific dollar amounts are used. So it specifically says $4,000 and $16,000. That's really, really important to get full marks. And that is part of linking it back to the question, because in the question tells you how much the loan is. So you need to be able to talk about how much is current and how much is non-current. Okay, here's the next question. The business has earned $6,000 worth of interest on a term deposit. How is this interest classified? And I'll give you a minute to think about the classification. Okay, so the correct classification is revenue, and that's because the interest earned is an increase in assets that leads to an increase in owner's equity that is in capital contribution. So it would be $6,000 worth of interest revenue. And again, specific dollar amount used, the term is stated, and the definition. Okay, next question. A business purchases a van for $20,000. What would this van be classified as? So I'll give you a minute again. Okay, so the correct answer is it's a non-current asset because it's an asset that the business will use for more than 12 months. And again, term, definition, and linking it back to the question by stating the specific amount. Okay, next question. The business owes $5,000 to their accounts payable. How is accounts payable classified? I'll give you a minute. Okay, the answer is current liability because it's an obligation that will be settled within 12 months. $7,000 of wages were paid by the business. How are these wages classified? Okay, the answer is that it's an expense. The wages are a decrease in assets that leads to a decrease in owner's equity, that is drawings. So it's $7,000 worth of wages expense. How would $10,000 of inventory be classified? I'll give you a minute. So it would be a current asset because it's an economic resource that will be sold within the next 12 months. So as I mentioned before, the accounting equation is assets equals liabilities plus owner's equity, and this introduces us to the double entry system of accounting. And there are two rules that are involved. Firstly, every transaction affects a minimum of two elements from within the accounting equation. So it could be assets, liabilities, assets, owner's equity, liabilities, owner's equity, so on. And the second rule is that the equation still needs to balance after the transaction has been recorded. So after you've made an entry of a transaction, the entire accounting equation should still be able to balance. So this is what a general ledger looks like. There's a left and a right side. Certain transactions will go into the left side of the ledger, and some transactions will go into the right side of the ledger. And then at the top there, where it says ledger account name, that is the name of the ledger account. So, for example, if this was the ledger account for cash at bank, it would say bank. So, for example, it could be the inventory account, and you can see there's a transaction that has been entered into the left side of this ledger account. So, if a transaction is entered into the left side of the account, it's called a debit entry, and if a transaction is entered into the right side, it's called a credit entry. So think of it as left is debit, right is credit. A huge mistake that people make is they think of debit as plus and credit as minus, or debit as minus and credit as plus. Don't think of it as increase or decrease. That's not how it works. Just think the left side is the debit side and the right side is the credit side. Don't think of it any other way because it will overcomplicate it and you'll end up confused. So you can see the left side of this account is highlighted purple, which is the debit side, and the right side is green. So left side debit, right side credit. Remember that. So the meaning of debit and credit change depending on what type of ledger account we're dealing with. So this is why I said don't think of debit and credit as increase or decrease. Just think debit is left and credit is right, because the meaning of debit and credit changes depending on the type of ledger account. So here are the different types of ledger accounts. We have asset accounts, liability accounts, owner's equity accounts, capital contribution and drawings accounts, revenue accounts, and expense accounts. And here they are color-coded according to their different rules. So, asset, drawings, and expense accounts are grouped together. So for asset, drawings, and expense accounts, debit means increase and credit means decrease. And then, meanwhile, for liability, contribution, and revenue accounts, debit means decrease and credit means increase. And here are those rules summarized into a table. So when you're first starting out with using the general ledger and the general journal, and you're doing your first few transactions, you can have this table somewhere and refer to it. But really you need to memorize this because you're not going to have any sort of bound book for your Saxon exam, and it's really important that you know these rules, which types of accounts have which rules, in order to answer questions that require you to do these entries. So yeah, eventually you do have to memorize these rules. Okay, we're not going to jump straight into posting transactions to the general ledger just yet. First, we need to know the general journal. So the general journal is used to record transactions before we enter them into the general ledger. This is what the general journal looks like. The first column is titled date, which is where we write the day and the month that the transaction happened on. The second column is details, which is where we write the names of the ledger accounts that will be affected by the transaction. If an entry is a debit entry, we'll write the dollar amount to the debit column. And if an entry is a credit entry, we will write the dollar amount in the credit column. There's a process we follow when we record a transaction in the general journal. So firstly, we need to figure out which accounts are affected by the transaction. We need to know the effect on each of the accounts, increase or decrease. And then we need to determine whether each amount should be debited or credited based on the type of ledger account. And remember that different types of ledger accounts have different debit and credit rules. And then finally, we can post the transaction to the general journal. So here's an example that we'll do together. So the business purchased $400 worth of inventory on the 2nd of February. So we'll go through the steps one by one. Firstly, we need to determine which accounts are affected by the transaction. So in this case, that's inventory and bank. The business is buying inventory with cash. And then the effect on the transactions, so inventory will increase because we're purchasing inventory, so we're going to get more inventory, and bank decreases because we're spending money to purchase the inventory. Okay, and then moving on, we have to figure out whether each account needs to be debited or credited. So for this step, we'll pull up our table from before that summarized the rules. So that's our table from before. So the bank account and the inventory account are both asset accounts. So they will be in this pink group here and they'll follow the pink rules. So they both follow the rules of asset accounts. So for asset accounts, an increase is a debit and a decrease is a credit. And as we established, inventory will be increased. So according to the rules, inventory is debited. So we debit the inventory account. And on the other hand, we need to decrease bank. And so we'll credit bank. So yeah, we need to credit the bank account. And then finally, the last step is to actually record the transaction into the general journal. So keep in mind what we just decided, everything we just went through, which basically is we need to debit the inventory account and credit the bank account. So now we'll enter this into the general journal. So again, debiting inventory, crediting bank. Here's our general journal, and this is what it looks like entered. So there's a few things to note here. We have the date that the transaction occurred, which is the 2nd of February in the first column. The first line is to debit inventory, and under details you can see the account name inventory, and then the debit amount 400 is in the debit column. And the second line is to credit bank. So the account name bank is in details, and the credit amount $400 is in the credit columns. And there's some really important points that need to be pointed out. So first of all is the order. Inventory is first and bank is second. So when we enter a transaction into the general journal, we always put the debit entry first. So it always is debit entry and then credit entry. We never do credit first. And then secondly, you need to notice that there's a space before bank. So whenever we have a credit entry, we need to put a space before the account name. And we don't need a space for any debit entries. And then finally, the last line, there's a short summary of the transaction in that last line. This is called, this summary basically states the transaction is a cash purchase of inventory and also says that the source document that verifies it is receipt 41. And this is called a narration. And sometimes the question will say include a narration, or sometimes it will say narration not required. So make sure to pay attention to that. And when we write our narration, it's okay if what we're saying exactly varies a little bit. It's not about the specific wording, as long as you're summarizing the transaction and you include the source document. We can now use this general journal entry to help us post the transaction to the general ledger. So here's a reminder about what the general ledger looks like, and you can see that there's a left side for debit entries and a right side for credit entries and the account name at the top. And there will be different ledger accounts for every single element within the business. So now going back to our example, and this is the general journal entry that we just recorded. And remember, our goal with this entry is to debit inventory by $400 and credit bank by $400. So firstly, we'll debit inventory. So inventory has its own ledger account because it is a separate element within the business. It's a current asset. It's an inventory account. So for this transaction, we're using the inventory ledger account. And because we're debiting inventory, the transaction has been posted to the left side of the ledger account, which is the debit side. And you can see the transaction date is under date and $400 is under amount. You'll notice that the second column is called the cross-reference, and under this is written bank. So the cross-reference column is used to record the name of the other account involved in the transaction. So in this particular transaction, there are only 2 accounts involved, inventory and bank, but sometimes there could be 3 accounts involved. It could be bank, inventory, GST. And so if there's 3, then you'll need to put multiple account names under the cross-reference. Moving on, we have to credit bank. So for this, we need the bank ledger account. And because we're crediting bank, the transaction is posted to the right side of the ledger account, also known as the credit side. And again, the transaction date is under date and $400 is under amount. And again, the cross-reference, we need to write the other account involved. And in this case, that's inventory. And here are what those 2 entries look like in the inventory and bank ledger accounts respectively. And note that the cross-references are the opposite account. Here are some entries that you're more likely to come across in the general journal questions. So cash sales, cash purchases, credit purchases, receipts from accounts receivable, payments to accounts payable, capital contributions, and drawings. And there are still other transactions not on this list that you will need to learn about later in the accounting course, but for now, just focus on these transactions. Okay, moving on to the GST clearing account. So GST stands for Goods and Services Tax, which is levied by the federal government. This tax is 10% on most goods and services. GST applies to all goods and services except for fruit, loans, wages, interest, drawings, and capital contributions. So GST is an additional 10% of the price on goods and service transactions. When you get an accounting question that includes GST, there are two ways in which it will be presented. It'll either be plus GST, which means that you need to calculate GST on your own and add it on to the amount. In these types of questions, the price provided in the question does not include GST, which means that you need to calculate GST on the amount and add it on. And you'll need to add on that GST yourself in order to determine the total price of the transaction. And to add on GST, you multiply the price by 1.1. And the second type of question will be including GST. And in these questions, the price provided does include GST, and therefore it's the total price. So if you want to find the price excluding GST, you would divide the price by 1.1. When the business receives GST, for example through sales, that GST does not belong to them. The business collects GST on behalf of the Australian Taxation Office, which basically means that any GST that the business receives is owed to the ATO. And this creates an obligation of the business to pay that GST to the ATO. Therefore, it is a liability. However, when the business pays GST, for example, to suppliers or when they're paying for expenses, this reduces the amount that they owe the ATO, and thus it reduces the business's GST liability. So if the business receives an amount of GST that is larger than the amount of GST that it pays, then GST is a current liability, which is an obligation to pay the ATO, and this means that the business owes the ATO, or the Australian Taxation Office, a GST settlement. However, if the business pays an amount of GST that is larger than the amount of GST that the business receives, then GST is a current asset because the business will receive cash from the ATO. So which basically what this means is the ATO, or the Australian Taxation Office, owes the business a GST refund. So therefore, GST clearing can either be a current liability or a current asset, and it depends on how much the business pays versus how much it receives. However, it's important to note, because businesses use markups, the business's selling prices are higher than the cost prices. This is necessary for the business to make a profit. However, this also means that it's much more likely for a GST settlement to occur rather than a GST refund. So thus, GST clearing is more likely to be a current liability rather than a current asset, which means it's more likely that the business will have to pay a GST settlement to the ATO, which is why we assume that GST clearing is a liability, unless the business ends up paying more GST than it receives. There are a few events that could occur in a period that would result in payments of GST being more than receipts of GST, and that would be, for example, if the business makes a large expensive purchase. For example, they could purchase a van or some other type of expensive non-current asset. So if that happens, then it is possible for the business to pay more GST than it receives. And in this case, then GST would be a current asset, which means that the business is owed a GST refund from the Australian Taxation Office. But usually this is a rare occurrence because the business will only make a large purchase every now and then. It's not really something that occurs regularly. So because of this, we assume that GST is going to be a liability, therefore it follows the rules of a liability, meaning increase in GST clearing is a credit and a decrease in GST clearing is a debit. So we assume that it's a liability unless it's proven that it's an asset. Okay, at the end of each reporting period, we prepare a pre-adjustment trial balance, which is basically just a list of all of the general ledger accounts and their balances at the end of the reporting period. These balances could be a debit balance or a credit balance. Certain ledger accounts always have a particular balance no matter what. So, for example, inventory will always have a debit balance because it's just impossible for a business to have negative inventory because that's a physical product that they have in their hands. So, it literally is impossible for the business to go into the negatives with inventory. Another example is accounts receivable. Accounts receivable will always have a debit balance because it's an amount owed to the business from customers. Another example, loan accounts will always have a credit balance because it will be an amount owed by the business to the bank. Accounts payable will always have a credit balance because it's an amount owed by the business to suppliers. There are other ledger accounts that can have either a debit or a credit balance. So this includes bank because the business could have a positive bank balance or a negative bank balance. And then another example is GST clearing, which we just went over. So obviously GST clearing can either be a liability or an asset, and so therefore it's possible for it to have a credit or a debit balance. So here's an example of what a completed pre-adjustment trial balance looks like. You can see 3 columns, account, debit, and credit. In the account column is a list of the names of every single account from the general ledger of the business. So every single general ledger account that the business has is included in that list under account. So they have a bank account, an inventory account, an accounts receivable account, an accounts payable account, a loan account, credit sales, cost of sales, wages expense, and owner's equity or owner's capital. Then beside each account name is the balance of that account at the end of the period. So if the account has a debit balance, then that balance amount is under the debit column, and if the account has a credit balance, then that balance amount is under the credit column. Then you can see in the bottom line there's the totals. So we have the total of all debit balances and the total of all credit balances. And if all of the recording of the business has been done correctly and there's been no mistakes, then ideally, both of these balances should match because, like I said before, under double entry accounting, all of the debit entries must be equal to all of the credit entries, and so therefore, at the end of the period, all debit balances must be equal to all credit balances. So all debits should be equal to all credits, and so the balances should be the same. And as we saw, the pre-adjustment trial balance lists all ledger accounts and their balances, but how do we get those balances? So there are a few balancing methods. The first one is footing, which is basically a method of informally calculating the balances of accounts for the pre-adjustment trial balance. There are 3 steps to footing. Number 1, total all debits of the account on the left and all credits of the account on the right. 2, deduct the smaller total from the large total, which will give the balance of the account, and then write this balance on the side that had the larger total. So here's an example of a completed general ledger account from the end of a reporting period. So first we'll total the debit side, or the left side, and this debit total comes to $18,000. Next we'll total the right side, which is the credit side, and the credit total comes to $9,800. The next step is we subtract the smaller total from the larger total. So the smaller total is $9,800, which is the credit total, and the larger total is $18,000, which is the debit total. So we'll do $18,000 minus $9,800, which gives us $8,200. So this is the balance of the account. And then the final step is to write this balance under the side that had the larger balance. So in this case, that's the left side. So we'll write the balance $8,200 under the debit side of the ledger account. And lastly, we just put a circle around that balance to clearly show that that's the balance of the account. So that's footing. That's how we do footing. It's, like I said, it's informal. So when we're actually balancing the ledger accounts, we'll need to be a bit more, like actually write the totals down properly, but this is just an informal way of balancing an account. Okay, it's also important that you know the purpose of the pre-adjustment trial balance. You can be asked this in a theory question. And basically, the reason why we prepare a pre-adjustment trial balance is to use it as a double-checking mechanism. So going back to our completed pre-adjustment trial balance, what we're double-checking is these totals. Like I said before, the totals of the pre-adjustment trial balance have to match. So all debits must equal to all credits, and so the debit and credit balances should match. The total should match. If the totals don't match, then we have to check for and correct any mistakes or any errors we might have made. So common errors that are made in double entry accounting include incorrect calculations, for example, calculating GST wrong amounts, so the amounts could be copied incorrectly from the source document. For example, if the source document says $1,000 but you accidentally write $10,000. Another common mistake is the wrong accounts. So for example, if someone accidentally debits accounts payable instead of debiting accounts receivable, or other examples, and that's just mistakes that people make. And then the last common mistake is swapping the debit and credit. So for example, you debited accounts receivable and credited bank instead of crediting accounts receivable and debiting bank. After we've identified any errors and we fix those errors and our pre-adjustment trial balance, the balances match, then we can formally balance the ledger accounts. And this is called balancing, which is basically the formal version of footing. It's important to note that only asset liability and owner's equity accounts are balanced. We do not balance revenue and expense accounts. And there's a 3-step process to balancing. Number 1, we total all debits and credits. So whatever the larger total is, we write it on both sides. And then we calculate the balance of the account by subtracting the smaller total from the large total, and then we add the balance in as an entry and match the balance to carry it forward to the next reporting period. And another key tip is to only balance a ledger account when VCAR explicitly asks you to. So similar to like the narration, the question will tell you whether they want you to include a narration or not. And another is similar with balancing. The question will tell you whether they want you to include balancing or not. Okay, so that brings us to the end of content block 1. So we'll take a very, very short break, maybe 5 minutes, just so you can run and use the bathroom or get a drink of water or whatever you need to. And then we'll come back after 5 minutes and continue on with content block 2. Okay, so hopefully everyone's back and ready to keep going. So we'll move on now to the second content block for today, which is a little bit less content than content block one. Content block one was a bit full on. This one is a little more relaxed, slightly. Okay, so as I mentioned right at the start when I was going through the definitions and terms and the assumptions, qualitative characteristics, and elements. A big difference between accounting units 1 and 2 and accounting units 3 and 4 is the type of businesses that we deal with. So, in units 1 and 2, you might have dealt with both trading and service businesses with a range of ownership types. But moving forward, we'll only be dealing with trading businesses that have one owner. So, a trading business is a business that buys inventory from suppliers, applies a markup, and then sells the inventory at a higher price to make a profit. So, common examples of trading businesses are clothing stores, but really it can be any business that sells physical products instead of selling a service. So, basically, trading businesses buy inventory, jack up the price, and then resell the inventory. But what that means is that inventory is the main source of revenue for a trading business. And because of this, it's also one of the most important assets that a trading business has. Okay, so for transactions that involve inventory, we use what's called an inventory card. And this is what an inventory card looks like. At the top of the inventory card is the information about the specific inventory that the card is talking about. So you can see the item name, which is extra large blue shirts, the item code, which is D4A0375, the item location within the store, which is aisle 8. So in this case, this is obviously some sort of clothing store and they have their inventory organized in aisles that you can walk down, which might not be true for every single store. Like, I don't know, they might have sections, like how Kmart has like women's, men's, children's, like stuff like that. And then also included in that information at the top of the card is the name of the supplier that the business has purchased this item from, which in this case is Atlantic Apparel Warehouse. And then it's important to note that there will be a separate inventory card for every single specific type of item of inventory that the business has. So there'll be a completely different inventory card for large blue shirts and for small blue shirts and for medium blue shirts and for extra large blue shirts and for extra small blue shirts. And there'll be a completely different set of cards for red shirts. So there'll be a separate card for extra small red shirts, for small red shirts, for medium red shirts, for large red shirts, and for extra large red shirts. And then a different set of cards for green shirts. So as you can imagine, when it comes to big businesses, like for example, imagine Kmart, they would just have thousands and thousands of inventory cards because for every single different type of product that they have, for example shirts, pants, toys, like Kmart sells everything pretty much. For every single different type of inventory product that they have, there'll be a different set of inventory cards, and then even just within that set, there'll be so many. Like you have to do a separate one for each different color, for each different size, for each different type of fabric. Like there will just be so many inventory cards. But obviously, when we think about smaller businesses, that might not be true. For example, I don't know, a business that makes all of the clothes that it sells, for example, like a crocheting business. Because the business is making it themselves and then selling it, it's not going to have as much inventory stock, as much of a range. But it's also possible for a small business to still have a really big range of products. For example, think about those like small businesses that are kind of like $2 shops, like they kind of sell everything. Like that's the whole appeal of a $2 shop. It's like you can walk in and find almost anything and spend, only $2. But they still have a really large range of products, but really those $2 shops are small businesses, they're run by locals. Um, but yeah, most likely, a small business will have a very specific type of imagery that they sell. Like you won't find, well, with exceptions obviously, but you won't tend to find a small business that sells kind of everything. For example, you might have a small business that sells gardening supplies, or a small business that sells chairs, like different types of chairs and couches. But that's just for example. So yeah, depending on how big a business's inventory range is, there can be a lot of inventory cards that the business has to keep track of. Okay, so now we'll break down the actual columns of the inventory card. So the first column in the inventory card is date. So under this we write the transaction date, so the day and month. The next column is details. So under details we write the source document that verifies the transaction. So for example, this could be invoice 12 or receipt 4 or memo 8. The next section of columns is the in column, and within the in column we enter transactions that involve inventory that is coming into the business. So for example, when we purchase inventory, we're spending money and we're getting more inventory. So that inventory that we're purchasing is coming into the business. So if that makes sense. And then within that in column, it's broken up into 3 sub columns. So we have to enter the quantity, which is the number of items, the cost, which is the cost per item, and the total, which is the total price of that inventory that is coming into the business. So for example, with a purchase of inventory, let's say we're purchasing, 5 shirts, 5 extra large blue shirts. Each shirt cost $10, and so the total is $50. So you would do quantity 10, cost $5, total $50. Or no, I think it was the other way around. 5 shirts for $10, or whatever it was. I don't remember what I said. So yeah, you get the point. Like it's quantity, cost per item, and total cost for all of the items. And then it's kind of similar with the out column. So the out column is used for transactions that involve inventory leaving the business. So for example, when we sell inventory, or even drawings, like the owner taking inventory out of the business. With both of those transactions, it involves inventory leaving the business to go to that customer or to go to the owner. And then again, it's broken up into 3 sub columns. So we enter the quantity, cost per item, and total cost of the inventory going out of the business. And then the final column is the balance column, and this is where we record the inventory that the business has left on hand. So after the inventory is coming in or after the inventory is going out, what is the remaining balance that the business has in their store, or kind of that the business has remaining. And again, we write the quantity, the number of items, the cost per item, and the total cost of all of the inventory that the business has remaining on hand. Okay, this is something that is super, super important when it comes to inventory cards. It's really, really important to note that all prices in the inventory card, and every single inventory card, are cost prices, and they don't include any GST. And then again, there are different inventory cards for each inventory line. So it's really, really important that you remember that when we are entering transactions in the inventory card, we always enter cost prices, never selling prices. Even if we're recording a sale of inventory, which obviously involves inventory going out of the business, we would never ever write the selling price in the inventory card. We only would write the cost price. So this means there are no selling prices in an inventory card, and all of the prices, even the cost prices, are excluding GST. So we never include GST in any of the amounts. And one of the easiest mistakes that people make with inventory cards is to include a selling price or to include the GST of the price. So that's really, really important to remember. Okay, now that we've gone through that, let's do an example together. So here's our example. We're recording for the month of February, so because of that, it's telling us that the opening balance at the start of February, or at the start of the reporting period, and that opening balance is 20 extra large blue shirts, each valued at $10. So the first thing we need to do is enter this opening balance into the inventory card. So under date, we would write February 1st because it's the opening balance, so it's the start of the period, which is the first of the month. And then under balance, under details, we have balance because it's opening balance. And then under the balance column, we have the quantity, cost, and total price of the shirts on hand. And that's 20 shirts at $10 each, which is a total price of $200. So again, to get the total, we multiply quantity by cost. It's important to note that under details I've written balance. So I know I told you that the details column is for source documents, but this is one example of an exception to that. So when we're recording a transaction, we'll write the source document under details, but because we're only entering an opening balance in this case, which is not a transaction, we write balance. And this only applies for opening balances. Okay, here's the next example. So we have our first transaction of the month. So on February 4th is the first transaction of the month that involves this specific item. So this doesn't mean that this is the first transaction of the entire month. It's only the first transaction that involves extra large blue shirts. So say on the 2nd of February, the business sold a whole bunch of green shirts, but unfortunately this inventory card is only talking about extra large blue shirts, so we only will only enter a transaction into this inventory card if it involves extra large blue shirts. Okay, and the specific transaction is that the business has purchased 25 extra large blue shirts for $10 per shirt. And you can see that they've given us the source document used to verify this transaction, which is invoice 101. And when we enter this transaction, this is what it looks like. So under date is the transaction date, which is February 4th. Under details is invoice 101, which is the source document that verifies the transaction. And because this is a purchase, it involves inventory coming into the business. So it goes into the in column. And under the in column, we've recorded the quantity, cost per shirt, and total price of the inventory purchased. So 25 shirts at $10 each, which is a total cost price of $250. And note that all of these prices are cost prices and they do not include GST. So you can see in the question it says plus GST, so that would be $11 including GST, but in this case we're not including GST. And again, this goes back to the main rules about prices in the inventory card, which is that it's always cost prices and never includes GST. And finally, in the balance column, you can see that the balance of inventory on hand has changed. It's been updated. So it's gone from 20 shirts to 45 shirts. So inventory that has come into the business has been added on to the balance. Okay, moving on, here's our second transaction for the period that involves extra large blue shirts. So on the 7th of February, the business sold 5 of these shirts for a total selling price of $165, including GST. And the source document that verifies this transaction is receipt 13. And this is what that entry looks like. So the transaction date, 7th of Feb, is written under date, and under details is receipt 13 that verifies the transaction. The transaction has been entered into the out column of the card because sales of inventory involve inventory leaving the business or inventory going out of the business. Under the out column, we've recorded the quantity, cost per shirt, and total price of the inventory sold. So that's 5 shirts at $10 per shirt, which is a total price of $50. And the question tells us that the shirts sold for $150 excluding GST, which is a selling price of $30 per shirt. But this price is not included in the inventory card at all, and that's because we have to use the cost price of the shirts, which is $10 per shirt. Because again, remember, cost prices, no GST. And again, the balance column has been updated. It's gone from 45 shirts down to 40 shirts on hand. So the inventory that has left the business, or the inventory that has gone out of the business, has been subtracted from the balance of inventory on hand. A lot of the time, the cost prices of inventory don't just stay the same, they actually change. And this can be due to higher demand or suppliers having sales. And when there are different cost prices, it has to be listed separately in the inventory card. So let's go back to our example from before. We still have the exact same opening balance of inventory on hand, so we still have 20 extra large blue shirts at $10 per shirt and a total opening balance of $200. This time though, our first transaction has changed slightly. So the business has purchased 25 shirts for $15 per shirt. And you can see that this is a change in cost price. It has increased. The cost price of these extra large blue shirts has increased from $10 per shirt to $15 per shirt. And this just might be the supplier has decided to increase their selling prices because there's a high demand for their extra large blue shirts. It's a popular item. So they've decided to start charging more for extra large blue shirts. And as a result, you as the business you can either choose to keep buying from that same supplier and just cop the extra cost price, or you can decide to look for a cheaper supplier. Those are pretty much your only options. But in this case, obviously, the business has chosen to keep purchasing from the supplier, even with the increased price of the inventory. Okay, and now this is how we enter that transaction into the inventory card. So under date, similarly to what we did before, under date is February 4th, and under details is invoice 101. That's the exact same as the last time we did this example. The transaction still goes in the in column because it's a purchase, so inventory is coming into the business. The quantity, cost, and total of the inventory coming in is recorded, which is 25 shirts at $15 per shirt and a total of $375. But the main difference is under the balance column. So there are two lines for the balance of inventory on hand. The two cost prices have been listed separately. So we have kind of two batches of inventory. So we have the first batch that we already had on hand, which is 20 extra large blue shirts that were valued at $10 per shirt for a total of $200. And we have the second batch of inventory, which is 25 shirts at $15 per shirt for a total of $375. Okay, so when cost prices are changing, there are two methods that we can use to allocate the cost of inventory leaving the business. The first one is identified cost, and the second one is first in, first out, or FIFO. If a business chooses identified cost, every single item that the business has on hand, so every single individual physical product that the business has in their store that they're intending to sell, must be labeled in some way that is identifiable. So probably the most common example of this that you might have seen in stores is having tags on certain items, or even having stickers that have barcodes. So when inventory has barcodes, the business can identify the exact cost price of that specific physical product whenever an item is sold. So, for example, every time they sell an extra large blue shirt, they will take the shirt and then the cashier will scan the barcode on the tag, and then that barcode will tell the computer system of the business that this extra large blue shirt cost $15. And so that particular sale, you'll record the cost price at $15 instead of trying to guess the cost price. Because obviously in your inventory card, you have multiple batches of inventory. So you're not too sure about which batch, but if you have barcodes, you can actually accurately tell what the cost price is. And for identified cost questions, you'll be told the cost price as part of the question. So you can see an example of this where a sale has occurred and the question is telling us the exact cost price of the inventory. So here's an example. It says on the 4th of February, the business has sold 5 shirts for $165, and it says the cost price of the 5 shirts was $15 per shirt. So when we have a question, an inventory question that is where the business is using the identified cost method, it's a little bit easier for you guys because the question will just straight up tell you the cost price of the item that is being sold, which is a lot easier for when you have to record in the inventory card. And obviously, identified cost as a method is very, very accurate. And so most of the time it's preferred because you're going to have your records and your reports being as accurate as possible, right? Because you're using labeling and barcodes to ensure that when you're selling a product, you're recording the correct cost price of that product. However, even though the method is very, very accurate, sometimes it's just not possible for the business to use identified cost. So, for example, if a business has inventory that's really, really small, so for example, a hardware store, right? Like, for example, like Bunnings, but obviously a smaller version of Bunnings. Bunnings is a huge, huge store. Think of like a small business that sells like hardware, like specifically they sell like drills and drill bits, and they sell like nails and screws and like nuts and bolts. So obviously like nails and screws are really, really small. They're really, really tiny and fiddly. And so, sometimes like they're so small, it's just impossible to put a sticker or a tag on every single individual nail. Or maybe it is possible. Like, technically, you could get someone to sit there and sort through like 5,000 screws and stick a tag to each individual screw. But is that really ideal for the business? So sometimes, even if it is possible for the business to individually label every single item of inventory, the business owner might decide that it's not worth the time and cost, because obviously when a business decides to use the identified cost method and they decide, okay, we're gonna add a tag and a sticker to every single item of inventory that we're selling, that's not just gonna magically happen. They have to, get one of their employees to sit and add a tag or add a sticker on to their inventory, and that will you have to pay that employee for those hours where they're just sitting there sticking tags and labels onto your inventory, which sometimes, depending on your range of inventory, how much inventory you have, sometimes that could take hours and hours and hours worth of time. And the business might decide, that time and the cost that you're putting into paying that employee to sit there and label these inventory items, that time and cost could be put into other areas of the business, or that employee could be doing something else that's much more beneficial to the business instead of sitting there for like 7 hours just adding tags and labels onto inventory. And so the business owner makes the executive decision that it's just not worth it to use identified cost. So like I said, in an ideal world, every single business would be able to use identified cost because it's the most accurate method. You're going to have the specific cost price of every single product that you're selling, which is, way more accurate. But the problem with identified cost is it's either sometimes not possible, and in other cases, it's just not practical. It's just not it's just not worth it for the business. So at the end of the day, it ultimately is up to the business owner about whether they think identified cost is worth implementing. So, sometimes, a business really shouldn't be using identified cost because it's taking, them hours and hours and hours to individually label every single item of inventory. But if the business owner wants, a really, really accurate inventory card, and they want to know, like, 100% without a doubt what the cost of sales and cost of goods sold is, then that's up to the business owner. It's their prerogative to decide whether they want to use identified cost. But in the case where identified cost isn't used, either because it's not possible or it's not worth it, we will instead use first in, first out, or FIFO. Okay, before I even tell you what FIFO is, the most important thing to remember with FIFO is that it's an assumption. So with identified cost isn't an assumption. Identified cost is just you put a sticker on every single item of inventory, and then as it's sold, you scan the sticker, or you scan the barcode, or you scan the tag, or you scan the label, or whatever, and it'll tell you on the screen, this shirt cost this much money. This was the cost price of this shirt, and you write that down in your inventory card. With first in, first out, there's nothing like that. It is literally just an assumption that we're making. So when we use first in, first out, we assume that the inventory that was purchased first is sold first. This doesn't mean that this is what actually happens, but this is what we assume happens. So probably the biggest mistake that people make with questions like this, with cost allocation methods, is they think that if a business uses first in, first out, that means that all of their old inventory is sold first. That's not true. All it means is, from the standpoint of us, the accountant, we are assuming, and because we are assuming that, the report will reflect that assumption that any inventory that is purchased first will be sold first. So basically, the older inventory that has been on hand for longer is being assumed to have been sold first. So when there's a question that involves first in, first out, the cost price of the inventory will not be included in the question, and it's up to you to correctly select the correct cost price under the rules of first in, first out. So you can see in the example, the cost price of the sale is not given to us at all. So it says on Feb 4th, the business sold 5 extra large shirts, and it says the selling price. And then you would have to look at the inventory card and what has already been recorded, and according to that, you would have to use the first in, first out assumption to assume what the cost price of this transaction is. So hopefully that makes sense. Okay, FIFO can definitely be a bit confusing at times, but if you remember these rules, you should be fine. So, when there's a sale of inventory, we use the oldest cost price in the balance column, which is the oldest cost price on hand. When there is an inventory gain, we use the latest cost price in the in column, so whatever the last cost price in the in column is. When there is an inventory loss, we use the oldest cost price in the balance column, which is the oldest cost price on hand. And when there's a sales return, we use the latest cost price in the out column. So that can be a bit confusing, but if you just literally just memorize those 4 rules, I promise you first in, first out will be a lot easier to wrap your head around, and you'll be getting a lot more marks on questions that involve first in, first out. Okay, this is our last quiz question, so I'll give you a few minutes because it's a bit of a big one. So, the business has shirts on hand at different cost prices. 20 of the shirts have a cost price of $10 per shirt, and 25 of the shirts have a cost price of $15 per shirt. The business then sells 15 of the shirts. Using the first in, first out assumption, what is the cost price of the 15 shirts sold? So I'm going to give you 4 minutes time just to answer this question. Really take the time, go through the inventory card. If you have your answer already or you finish early, you can actually practice putting in this transaction, the 6th of Feb, the sale. Practice putting that into the inventory card. But yeah, I'll give you 4 minutes. Okay, so the answer is $10 per shift, and this is because we assume that the inventory that was purchased first is sold first. So we have to choose the oldest cost price on hand as the cost price for this sale. And in this case, the oldest cost price on hand is $10 per shift. You also need to know, just in general for your theory responses, the relevant financial indicators, and you need to know the term, definition, and you also need to memorize their formulas. So firstly, there's inventory turnover. This tells us the average number of days it takes a business to convert its inventory into sales. So when inventory turnover is slow, it means that the business is taking too long to convert its inventory into sales. This might mean that sales is too little, but it also might mean that the business has too much inventory on hand. So they're ordering more inventory than they're able to sell, which is resulting in kind of inventory piling up in their store. So that just might mean that the business needs to purchase less inventory at a time. And on the other hand, when there's a fast inventory turnover, this means that the business is converting inventory into sales too quickly. And this may mean that the business is losing potential revenue. And it might also mean that the business has too little inventory on hand. So they're selling out of products way too quickly. And so a way to improve that is to buy more or look into bulk buying their inventory, changing their selling price, because that also might mean that their selling price is way too low, so it's way too good of a deal for customers, which is why their inventory lines are selling out. They might want to rearrange inventory. So one kind of technique that a lot of businesses use, kind of like to trick their customers, is they have certain items of inventory that are really, really popular. So, for example, if it's a clothing store, let's say that they have a particular jacket that a lot of people buy, and it's kind of like a trendy jacket at the moment. Let's say that the jacket went viral on TikTok, and so a lot of people are coming into the specific store just looking for that particular jacket because that's their most popular item. So what the business can do is put the jacket kind of at the back of the store, which means that any customers that come into the store wanting to buy that jacket will have to walk through the entire store and walk past all of the other products in order to get to that jacket. So they're more likely to stop along the way and kind of pick up other items as well, instead of just buying that jacket, because that's kind of what they want to avoid. They don't want to just be selling one item. They want to be selling a variety of items. So yeah, and then they also could offer discounts. Okay, the next indicator is the accounts receivable turnover, which tells us the average number of days it takes the business to collect cash from accounts receivable. So if accounts receivable turnover is slow, this means that the business is waiting too long to receive cash from accounts receivable. And this might mean that the business will face difficulty meeting their short-term debts as they fall due, or they'll face liquidity problems. They have a higher chance of bad debts, which basically means that they have a higher chance of not collecting any cash from their accounts receivable, or having multiple accounts receivable not being able to pay at all. And it also means that the business might not have enough cash for other important needs. For example, purchasing inventory or repaying suppliers or paying off their debts, their loans, their interest, etc. So it's really, really important that a business doesn't have a slow accounts receivable turnover, because that's a really big part of the business's ability to generate cash. And cash is really important to a business. That's how they make purchases. It's how the business pays off its debts. So when there is a slow accounts receivable turnover, it's important that the owner addresses the turnover. And they can do this by offering discounts to their accounts receivable to incentivize the customers to pay quicker. They could send invoices promptly, so send invoices immediately and send reminder notices regularly so that the customer can't forget about the amount that they owe. And they could also hire a debt collection agency. And it's a key point to note that the same goes for the accounts, the inventory turnover and the next turnover, but these financial indicators are an average measure indicator. So it indicates the average. So with inventory turnover, it's the average number of days it takes the business to sell inventory. And with accounts receivable, it's the average amount of time it takes customers to pay. And with the next one, accounts payable, it's the average amount of time it takes the business to pay accounts payable. So this might indicate that most accounts receivable on average aren't repaying the business on time. So it might even just be one or two really, really slow accounts receivable, but most of your accounts receivable are fine. So that's when it's important to kind of look deeper into the issue and trying to target what the actual issue is. And then the last financial indicator for now, obviously later in the course there's a few other financial indicators that you need to know, but for now it's just these three. The third one is the accounts payable turnover, which tells us the average number of days it takes the business to collect cash from accounts receivable. And when there's a slow accounts payable turnover, it means that the business is taking too long to pay their accounts payable or their suppliers. And this may mean that the business loses its credit facilities and has a lower credit rating. They could incur deferral costs or miss out on discounts from suppliers. And they could even result in the business going bankrupt or having legal action taken out against the business. So it does have it can have quite serious consequences on the business. It's important to note that accounts payable turnover is largely reliant on inventory turnover and accounts receivable turnover. So obviously, the more you're selling inventory, the more you're going to have accounts receivable. And if accounts receivable are taking a long time to pay, you're not going to have cash on hand as a business, which might mean that you're unable to pay your accounts payable. So it's really important that both your accounts receivable turnover and your accounts payable turnover isn't slow. And a lot of the time, when your accounts receivable turnover is slow, it results in your accounts payable turnover also being slow. So the ideal situation is to have a high inventory turnover, a high accounts receivable turnover, and a low accounts payable turnover, but not too low. So what that means is you don't want, say if for your suppliers are offering you a 30-day credit terms for everything that you purchase. Obviously you don't want your accounts payable turnover to be 50 days because that means that you're going, 20 days over the credit terms, which is just unacceptable. Your supplier isn't going to tolerate that. They're going to get upset with you. They could pursue like legal action. It could affect your credit facilities, your credit rating, etc., etc. But instead, what you want your accounts payable turnover to be is like 29 or 28. So kind of slow, obviously, because within 30 days, that's pretty slow. It's on the higher end, but it's not exceeding credit terms. So basically you want to push off paying your accounts payable until the last possible moment while still staying within credit terms. So hopefully that makes sense. So you want your accounts payable, you want to be paying your accounts payable slow-ish, but not too slow where it's way more than the credit terms offered. So as slow as possible without breaching the terms that you've come to with your supplier. Your theory responses should also take into account non-financial information as well. This includes customer satisfaction, inventory quality, and employee morale. Obviously, like a business isn't going to be successful if all of the employees that are working for the business are really, really unhappy with the working conditions or it isn't they don't feel safe in the working environment. But obviously, like, that isn't going to be reflected in the financial reports. That is, non-financial information. Examiners and the people that are marking your SACs and your exams, they love when students include non-financial information in their responses because this kind of shows to them that this student, like, they don't just understand the content of accounting, of VCE accounting, they can also kind of take that knowledge and apply it to the real world. Um, Often this can even be like a really, really small detail that's included in the background information of the question that most students will just pass over. So that's why it's really important that you read your theory questions carefully, and you really identify details of non-financial information that may be useful within your response. Ethical considerations are another big part of accounting theory that some people can struggle with, but broadly it includes integrity, impartiality, objectivity, and confidentiality. Integrity is a really, really big one with ethical considerations because it's super important that a business is honest in their financial reports. And then under ethical considerations, we also have to consider the financial, social, and environmental implications of business decisions. A business has to make decisions that don't harm the environment. So, for example, ideally they should be recycling, they should be using eco-friendly packaging, don't use plastic. They should be trying to reduce their waste as a business, etc. And businesses should also have a positive social impact. So they shouldn't be purchasing from sweatshops, or they shouldn't be purchasing from, overseas suppliers that don't pay their workers properly, or, don't have safe working conditions. And instead, the business should be trying to purchase from local suppliers from within, Australia. Because when you purchase from local suppliers, you're supporting the local economy and you're having a positive socio-economic impact. So here are some examples of ethical considerations that you could be asked about throughout Units 3 and 4. But really, ethical considerations can be asked about really any part of the course, and a lot of the time, these questions will require you to think outside of the box with your responses. And that brings us to the end of the content for today's lecture. That was definitely a lot of content, so good job if you made it all the way through in one sitting. And thank you so much for tuning in.